That sounds risky, but we were trying to emphasize, wait a minute, there's something big happening here. It had disappeared from the lexicon of the financial markets because of the muscle memory associated with the tech and telecom bubble.
Yeah.
That's why what we were doing seemed so crazy. When I use the word disruptive, financial managers do not use disruptive. That seems scary, right? So that sounds risky, but we were trying to emphasize, wait a minute, there's something big happening here. Genomics analysts have a good understanding of the brain. Neural networks are patterned after the brain. Our artificial intelligence analysts must communicate with our genomics analysts, and they do. We have a very collaborative. So I believe we are, at this time, seeing an explosion in the convergence between and among technologies. And it's one S-curve feeding another S-curve, feeding another S-curve, and there's going to be explosive growth that most people in the financial world do not expect, because they're not set up this way. They're set up very siloed by specialization. Our investment time horizon is 5 years. We have to believe that within 5 years, we will be able to model out a company's, revenue growth and EBITDA growth, and understand that it's either at the cusp of hitting prime time or in the middle of prime time. It is astonishing, and costs are a big part. That technologies have to be ready, cost has to be low enough. The problem with the tech and telecom bubble was too much capital chased too few opportunities, really chased a dream. All of the seeds for the explosion in innovation that's happening now were planted in the 20 years that ended, and Tom, you might say 30 years
completely
that ended in the tech and telecom bubble. And those seeds needed time to gestate. The technologies weren't ready. Cisco and Oracle and Hewlett-Packard were not going to take us into the cloud world, the AI world, the way we are now. So the technologies weren't ready back then. The costs weren't low enough. A good one is DNA sequencing. I hope you don't already know this, given the audience. Maybe you do, I apologize. But in the financial world, this is pretty impressive. The first whole human genome was sequenced. Now, I learned that it was completely sequenced just a few months ago, but anyway, we thought it was sequenced in 2003, right?
No, we didn't.
We financial market, 2003, so you go back and you figure out how much did that cost. It cost $2.7 billion, and it took 13 years of computing power. Even if costs had dropped 75% the next week, and computing had had increased in power, by 75% and speed, still wouldn't have been ready the next day. Okay, now we're down to $500, a few hours of computing power. Now we're talking. What's beautiful about what's gone on for us, at least, is there was a shift because of the tech and telecom bust. And then the 2008 and 2009 meltdown. The risk aversion in the public equity markets became extreme. Career risk, business risk, that's all anyone thought about, and they figured that just let me stay close to my benchmark and I'll be fine from a business point of view, career point of view. Wrong. They actually are being dealt out of the game by robo advisors and so forth. What's happening today, nobody really understands in the financial markets because they've invested so much of their time in the benchmark stocks, which are very backwards looking. So I believe that was the most massive misallocation of capital in the history of the world. And one of the things, no, I'm not exaggerating, in the history of the world, and that, to be a little disruptive in the financial markets was to start investing in the future again. I had one person who wasn't in our business. I was trying to explain what I was trying to do before starting the company. He said, "Oh, you mean the future of investing is investing in the future? And I said, yes, yes. That's how much the financial services industry had lost the plot. And, and we're considered, in the beginning, most people thought we wouldn't make it. But the convergence of these technologies is creating explosive opportunities like Tesla. So to give you just to answer Tesla, what did we see? We invested at my old firm in 2012 and since the beginning in 2014 at ARC. What did we see? This was not an auto company, yet auto analysts were analyzing it. What kind of analysts should have been analyzing Tesla? We have 4 analysts focus on it at ARC. Robotics, autonomous vehicles will be robots. Energy storage, they will be electric, cheaper. Artificial intelligence, they will be powered by artificial intelligence. And software as a service, over-the-air software updates to change performance. So we had a competitive advantage. Most people were laughing at us because the traditional auto manufacturers and auto analysts were laughing at Tesla, saying, oh yeah, right, Tesla's going to build its cars on top of cell phone batteries. Ha, ha, ha. It's impossible engineering feat. It wasn't impossible. Elon did it. So we have an open research ecosystem patterned after open source software. So we call what would be called software developers in the open source software world, we call theme developers. And they come to this brainstorm on Fridays and can collaborate with us on our intranet. So the theme developers, interestingly, include people who are doing research and are passionate about pushing the frontiers of knowledge forward. So they include professors, venture capitalists, and my biggest surprise after starting ARC is, of course, there are some great venture firms who do great research, but not many. And so we've had some venture capitalists who understand that dynamic and want to change it join us. Some entrepreneurs themselves, and other thought leaders, and many who are retired now. An engineer from IBM who killed it in terms of getting the internet right and is just a futurist in terms of the way she thinks. In the public markets, the aversion to genomics was extreme to me.
Really?
And yes, we own, thanks to Ali and Simon and Pierce, but Ali does our CRISPR work. We own pretty much all of the CRISPR names, and we might be the largest shareholder. And we started very early on, in 2015, I'm going to say, when these were sub-$1 billion companies. Apple is, I think it's nearly $2 trillion, if not there, in market cap. Apple has changed lives, changed my life, but it has not cured disease. The market's paying nothing for these. And even in the big biotech stocks, if you look at how analysts value phase 1 and phase 2 drugs, pretty much at nothing. And we know that thanks to artificial intelligence, DNA sequencing, CRISPR gene editing, other gene therapies that are in R&D, that their pipelines are probably worth a lot more than the market is giving them credit for, because if we're right, with artificial intelligence especially, we think trial failures will drop by 25% at least. Go to market will be 25% faster at least. And so the drugs they have in their pipelines are probably much more valuable, and the returns on R&D are going to increase from high single digits right now. Used to be 20, 30% during the golden age, 80s, 90s. From high single digits now, we think we will achieve returns higher than that 30%.